Hello, welcome to the Economic View today. I'm joined as always by Evan Lucas, our market strategist. Hi, Evan.
Hello, Tony. How are you?
Yeah, very good. Now, wanted to talk today about the Reserve Bank. Philip Lowe gave a very interesting address last night to the Business Economists annual dinner, and he made some really interesting comments about interest rates and also about wages. With interest rates, he basically gave a reason why the Reserve Bank hadn't cut interest rates of late, as to not inflame the housing market. So I thought that was quite interesting. But what are your thoughts?
Yeah, you also highlighted that the next movement will be up, but at the same time, that's a long, long way away. It's become quite interesting to see the fact that we now have almost one index to look at in terms of getting your barometer for what the RBA is thinking, and that's the wage price index, which comes out quarterly. It basically almost has become as influential as what the inflation read will be, all in the space of a very short period of time. And the fact that he really highlighted that as their core concern. He did point out also things around, as he said, housing, but also the amount of leverage inside the market. We even saw APRA's boss yesterday talking about that as well. So clearly that's an issue across monetary policy control and regulators, and that was the other part of it. He sort of almost fingered bosses for what's going on in terms of where the Australian economy sits, with the fact that they are clearly not getting rate rises, that clearly business has been cost cutting, and that's the way that they've actually grown themselves rather than actually putting it back into their business, which is also interesting in itself because there has been lower than expected economic growth in this country over the last 4 to 5 years, and under normal principles of not just economics but just investment theory as well, normally under that scenario you do see cost cutting coming as the major sort of thing that firms do. So again, push-pull figures. He also then went on to highlight that the low inflationary environment is almost a self-perpetuating circle, and the fact that because we've got low wages, we've got low inflation, we'll get lower consumption, therefore we'll get lower growth, making monetary policy lower for longer. That's a big circle in terms of what he's talking about there. And that was always the argument, again, from a theory point of view at university, is that that's the argument for deflation. Like, what happens in a deflationary market? How do you get yourself out of it? Now, we're not in that, we're in disinflation. But what he talked about is basically the textbook theory of what deflation is. So all of that feeds into it. Have a look at what's happened to the Aussie dollar. That's structurally changed. And I think that needs to be put out there. There is a structural deficit now moving in that currency. It's gone from being 81 cents about 3 months ago to 75 and trending lower still. And it is clear that they believe the currency is going further still. So his speech, I actually thought it was quite, for him, it was very neutral. He's been the more hawkish member I've seen around, and he's the most hawkish central banker we've had in the last 15 years. He has had to basically shed that hawkish feather and move to as neutral as he can, with possibly sitting on the side of a hawk, because he doesn't want to cut rates, but he's clearly highlighting the fact that things for him, in terms of what he looks at, are tough.
Yeah, I'd agree with that. I mean, the whole wages discussion is really so central to all of this and around what the Reserve Bank's doing. And clearly businesses have not been investing into wages. They've been investing into their businesses, albeit off of a slow rate. And that's just going to continue, which of course will affect shareholders as well as employees. So there's not going to be as much money going to employees or the shareholders in cases.
And to be fair to it as well, part of the reason we're currently experiencing this really low wage growth is, again, you've got to filter in and possibly even smooth out the mining boom. So if you have a look at also what came out of that speech, and also came out of the minutes yesterday as well, was that the mining investment period and the wage growth that came in mining was pretty astronomical and really did jack up Australian wages well and truly above the MSCI World Index. Quite a substantial way. If you now look at where mining sits, it's probably back to where it was pre the mining boom, which is where it should be. It's what you normally happen with that kind of cycle. So he did point out also that services are picking up. The catch is that wages have already moved up into this new band, and they're now not moving any further. You've got housing that is now sitting up much, much higher in terms of pricing and also debt levels and income levels. So that's where his whole sort of conundrum comes about, is that we had this mining boom that really did drive wages. I mean, look at what happened in Western Australia and Queensland particularly. Wage growth was absolutely astronomical between basically 2004 all the way up even to as far as 2013, including the GFC. So all of that filters into it. But despite the fact that services are picking up, in their words, the slack, it's not going to be anywhere near the kind of levels that a mining boom is going to have. And already that kind of area, the services sector, and this is the other part of his speech, it is one of the highest levels of disruption that's out there. If you want to look at what is typical, true globalization, new world disruption, it's services. The ability to have technology, cheaper opportunity from globalization, all that kind of stuff filters into that space. So yes, we're getting slack pickup, but the argument's already there from what isn't necessarily measurable in standard theoretical economics is coming from disruption. And he does point that out, that things like globalization, things like technology increases, also new world order with regards to working longer for less, all of that now comes into their thinking. And he points to the fact that it's actually caught them out. Their economists cannot model these new things. And that was also part of his answer last night.
Arguably, the Reserve Bank and others should have been all over this ages ago.
I agree. And not only that, like, you've had private economists look at the investment banks, pointed out, you've always got a good gauge of what it could happen to us in sort of 5 years' time with what's been going on in the US. I mean, look at what's been happening in the US. Digital disruption in the US has thrown huge disparities across the country. I mean, their manufacturing was always the core area that you could point to. But it's not just that. Look at their services sector as well. The services sector is under real downward wage pressure on the back of digital disruption. I mean, who now needs to have a scenario where you do need a retailer sitting at their bricks and mortar shop when you can go to Amazon? And we're about to experience that within the next few days, that Amazon comes online. That the old service sector is not what it used to be. It is online, and you can now get service from Bangladesh, from Southeast Asia, from Europe, from the US, all with a click of a button. And that makes that wage pressure and that competition for jobs all that much harder.
There's a whole discussion around automation and what that is going to do for jobs, which we won't do today, but I mean, that just feeds into the whole puzzle, really, of, monetary policy and what regulators around the world, including the Reserve Bank, are going to do over the long term.
Because that brings to the other side of this, is that monetary policy can only do so much. And this is where the argument has been, particularly from central bankers over the last 7 years, that fiscal policy, government, has to play a part. The issue with fiscal policy globally, we're even now seeing it in probably one of the more stable places in the world, in Germany, where the ability for fiscal policy to think outside of 3-year cycles is so hard because of their current setup, that having to look into what a globalized world looks like and the money that needs to be put in through fiscal policy to fix that, or not to fix that, to actually accommodate it and help your own nation, is also incredibly hard. And that's why tools like rate rises are sledgehammers, and they're not the only policy. And that's another thing that most central bankers will berate, is fiscal policy is not helping either.
So let's just end off quickly. The Reserve Bank's laid it out on the table once again. Rates aren't going anywhere soon. They will creep up. No time frame on that, but we're looking at a fair way off.
Look, very quick answer. Will there be rate rises in the next 12 months? Short answer, no. And I think that's the way to finish it. You can then reevaluate this time next year. But short answer, are we going to see rate rises from the RBA in the next 12 months? No.
Something for investors to keep in mind. Thanks very much, Evan.
Thanks, Tony.
Thanks for joining us on The Economic View.